Welcome back to Smart Stock Sam, the channel where we cut through the noise, ignore the headlines, and follow the actual data to find where the real money is moving. Today, we are diving headfirst into one of the most misunderstood, most mispriced stocks in the entire electric vehicle space right now, NIO. Wall Street just decided to absolutely hammer this stock on the same week the company reported its single best month of the entire year. 62% year-over-year delivery growth, expanding profit margins, institutional giants quietly loading up through the back door, and yet the stock got destroyed. So the question you need to be asking yourself is this: is Wall Street seeing something the rest of us are missing? Or is Wall Street completely dead wrong? By the end of this video, you will have the full picture: the fundamentals, the technical chart setup, the option structure, the institutional footprints, and one critical metric the financial media is completely ignoring. Stay locked in, because this is the kind of setup that only shows up a handful of times in any given year. So let me start by framing exactly what is going on here, because on the surface, none of this makes any logical sense. I call it the divergence paradox, the complete disconnect between what a company is actually doing operationally and what its equity price is telling you. On June 5th, NIO closed at $5.36, suffering a brutal 5.80% drop in a single trading session. If you were just staring at that red number on your brokerage app, you would think this company was melting down. A recall, a scandal, a guidance cut, maybe a fraud investigation. But here is the reality. The company just delivered 37,705 vehicles in May alone. That is a 62.3% increase compared to the same month last year. The company is selling cars at a pace that most American and European EV competitors can only dream about, and Wall Street responded by punishing the stock. The equity chart is flashing blood red, while every single operational metric is screaming bright, undeniable green. So what in the world is going on? The answer has absolutely nothing to do with electric vehicles. The real culprit is the macroeconomic environment, specifically a single data release that triggered a chain reaction across every growth and technology stock in the world. The U.S. just posted a jobs report showing 172,000 jobs added in May. In any rational world, strong jobs means a healthy economy, which is great for equities. But on Wall Street, good news is bad news. A hot jobs report means the labor market is still running too warm, inflation risks remain alive, and the Federal Reserve has absolutely no justification to cut interest rates anytime soon. When rates stay elevated, the cost of capital goes up, growth stock valuations get compressed, and algorithmic selling programs start unloading positions across the board. The U.S. market posted its worst single trading day since October, and NIO, as a high-beta, high-growth, emerging market EV play, got annihilated in the crossfire. This was not a fundamental rejection of NIO's business model. This was a sympathetic macro sell-off. They were the baby getting thrown out with the bathwater, and that distinction matters enormously for how you should be thinking about this opportunity. Now, let us set the macro fear aside and look at what is actually happening inside the factories, because this is where the story gets genuinely exciting. That 37,705 vehicle figure was not just a nice headline number. It represented a 28.4% increase month over month. Sequential acceleration, which tells you this is not a one-time lucky quarter. This is a company hitting its stride during a massive new product cycle. Two models are driving this surge, and they are attacking the market from completely different angles simultaneously. First, you have the Envo L80, a smart, 5-seat SUV designed to penetrate the high-volume, mass-market family segment, opening the door to millions of everyday consumers who could never justify a premium NIO purchase before. But then, on the opposite end, you have the NIO ES9, a flagship executive SUV built on a 900-volt high-voltage architecture priced from 498,000 yuan. This is the vehicle pulling the average selling price upward and dramatically improving the economics of every single car rolling off the production line. A mass-market volume driver and a margin-expanding flagship running in parallel. That is not an accident. That is deliberate, well-executed product strategy. And speaking of margins, this is the metric Wall Street is completely ignoring, and it is frankly the most important number in this entire story. Any EV startup can boost deliveries by slashing prices and practically giving cars away. That destroys the long-term thesis. But NIO is doing the exact opposite. Their vehicle gross margin has expanded aggressively to 18.8%, up from a painfully thin 10.2% in the first quarter of last year. In roughly 12 months, they have nearly doubled their per-vehicle profitability. This margin expansion secured the company its second consecutive quarter of positive adjusted operating profit. They are no longer just a cash-burning startup chasing volume at any cost. They are beginning to operate like a mature, scaled automotive business. And to cement this further, NIO just announced a strategic partnership with GigaDevice to co-develop automotive-grade semiconductor chips, a structural play designed to standardize components and systematically reduce supply chain costs for years to come. The fundamentals here are not just improving, they are genuinely turning a corner. Now let us talk about the charts, because if you are a technically oriented trader, what you are looking at right now is exceptionally rare. The 14-day Relative Strength Index, the RSI, is currently sitting at 25.95. Anything below 30 is the textbook definition of deeply oversold. The stochastic oscillator and Williams percent R are both screaming the exact same reading. The stock is pinned completely below its 5-day, 50-day, and 200-day moving averages simultaneously. Algorithmic systems have flagged this as a strong sell based on the MACD, which is showing a bearish reading of negative 0.11. On the surface, the technical damage looks severe, but here is what those algorithms completely miss. They are measuring momentum in the past, not the setup forming for the future. And when you zoom out on the chart, something remarkable is taking shape. Before this recent macro-driven drop, NIO was meticulously carving out a textbook cup and handle pattern, one of the most respected bullish continuation setups in all of technical analysis. The large, rounded bottom of the cup represents a long consolidation phase that wipes out the weak hands. What we are experiencing right now is the handle, the final, fear-induced shakeout. The question is whether the stock holds its critical support at $4.37. And honestly, what are the realistic chances that a company posting 62% delivery growth, with institutional giants loading up millions of shares, allows itself to collapse all the way to $4.37? Could it happen? Technically, yes. Is it likely given everything we know? The data says otherwise. Because if this level holds and the stock breaks out of its current downward channel, the theoretical cup and handle upside target measures all the way up to $9.63, nearly double from current levels. Now, I know some of you are already screaming short squeeze in the comments. Let me burst that bubble with hard data. Total short interest sits at 137.51 million shares, actually a 32-month low, meaning bearish pressure has already been easing for years. Days to cover sits at a standard 4.02 days, but the real nail in the coffin is the borrow fee, sitting at an almost laughably low 0.35%. There is zero stress on short sellers right now. Shares are cheap and plentiful to borrow. Any recovery here is going to be built on real business validation and technical mean reversion, not meme stock mechanics. Honestly, that is the healthier and far more sustainable kind of recovery. So, if retail is not the catalyst, who is actually controlling the price action? The options market is the real battleground. For the week of June 12th, the structure is crystal clear. Despite the drop to $5.36, options traders have maintained a surprisingly bullish stance, with nearly 71% of daily volume sitting in calls. But the single most critical data point in this entire video is the options floor. There is a massive wall of support at the $5 strike price, fortified by exactly 10,340 put contracts. Market makers who have sold those puts are mathematically forced to buy shares whenever price approaches $5. That is not a theory. It is a mechanical certainty built into how options markets function. On the upside, heavy resistance sits at the 550 strike with 10,372 call contracts stacked up and another significant wall at $6. The battlefield is clearly defined, and while the option structure protects the downside, institutional money is quietly doing something far more significant. Never listen to what Wall Street says. Watch what Wall Street does. Beneath all this retail panic, the most sophisticated investors in the world are aggressively accumulating NIO shares. There are currently 456 institutional owners holding a combined 280 million shares. But the recent 13F filings are the real headline. 2 Sigma Investments, one of the most elite quantitative hedge funds on the planet, just increased their NIO position by an astronomical 1,863%, loading up to 13.33 million shares. Point 72 Asset Management bumped their stake by 135%. Citadel Advisors added 40% to their position. These are not passive index funds following a benchmark. These are discretionary, quantitative institutions making a deliberate, aggressive bet on NIO right now. The smart money is buying the fear. Now, I want to address something you probably saw in the news that triggered a wave of panic selling. On June 1st, headlines screamed that NIO's CFO and president were dumping shares. Red flags everywhere. But here is the full context. Both executives had a combined 700,000 restricted share units, RSUs, that vested on that date. When equity compensation vests, it triggers an immediate income tax liability. Exactly half of those shares, 350,000, were mechanically sold at $5.60 strictly to cover that tax obligation. The executives retained the remaining 350,000 shares. This is called a sell-to-cover transaction, an automated, pre-programmed administrative event. It was not insiders running for the exits. It was the equivalent of your employer withholding taxes from your paycheck, except this one happened to be publicly visible in an SEC filing. Once you clear away that manufactured fear, the professional analyst picture becomes very interesting. The broader Wall Street consensus sits at a hold rating with an average target of $6.70, implying a clean 25% upside from current levels. But the trend in analyst sentiment matters more than the consensus, and it is moving decisively bullish. HSBC upgraded to a buy with a target of $6.80. Nomura upgraded to a buy at $6.60. DBS moved to a moderate buy. CLSA initiated with an outperform. The analytical community is collectively arriving at the same conclusion. This business is turning a corner, and the equity has not priced that in yet. If you want to validate or invalidate this thesis in real time, monitor 3 specific metrics. Metric 1, the June delivery run rate. Management guided for up to 115,000 deliveries in the second quarter. To hit that, they need somewhere between 42,000 and 47,000 vehicles in June alone. If they hit that range, mass market demand for the Envo and ES9 is confirmed. Metric 2, vehicle margin expansion. They hit 18.8% in the first quarter. Management targets 20%. Crossing that threshold is the structural point at which the vehicle business covers its operating costs and eliminates the cash burn concern entirely. Metric 3, macro sensitivity. Until the Federal Reserve actually begins cutting rates, NIO-ES valuation multiples stay compressed by U.S. macro anxiety. The moment the Fed pivots, and given the pace of global data, could that pivot realistically be further away than the market currently prices? This equity decouples from U.S. macro fears and begins trading purely on its own fundamentals. Based on everything we have walked through, the fundamental strength, the oversold technicals, the options floor, and the institutional accumulation, the directional bias for the trading week of June 8th through June 12th is a bullish mean reversion. Here is the trade framework. Entry zone sits between $5.26 and $5.35, entering near the Friday close on the extreme RSI signal. Stop loss is a strict daily close below $4.95 because if the $5 options floor breaks, it signals total capitulation and invalidates the setup. Target 1 is $5.50, aligning with peak call, open interest, and the 10-day moving average. Target 2 is $5.80 to $5.88, filling the technical gap and tagging the 200-day moving average. Clean, defined, asymmetric. Before we wrap up, here is the disclaimer every responsible investor needs to hear. Nothing in this video is financial advice. I am not a licensed financial advisor or a registered investment professional. Everything here is purely for educational and informational purposes. Stock investing involves real risk, including the potential loss of your entire investment. NIO is a high volatility, high risk international equity and is not suitable for everyone. Always do your own research, understand your personal risk tolerance, and consult a qualified financial professional before making any investment decisions. So here is the bottom line. NIO is operationally transformed, moving from a cash-burning startup into a scaled, multi-brand automotive ecosystem delivering 18.8% margins and 62% delivery growth. But U.S. macro fear has artificially crushed the equity to extreme oversold levels with almost no relationship to the actual business. Clear entry at approximately $5.30. Rigid floor at $5 backed by 10,000 put contracts. Technical target up to $5.50 and $5.80 on the bounce. The fundamentals are there, the smart money is accumulating, the options structure defines your risk, and the insider selling narrative has been fully debunked. Now it is simply a matter of execution and patience. Here is the comment question I want every single one of you to answer below. If NIO hits its June delivery target of 45,000 vehicles, do you genuinely believe Wall Street will finally reprice this stock to reflect the business reality? Or will macro headwinds keep suppressing it no matter what the company delivers? Drop your honest take. If this breakdown gave you real value, hit that like button right now. It genuinely helps Smart Stock Sam reach more investors who deserve data-driven analysis instead of clickbait noise. If you are not subscribed yet, what are you waiting for? We do this level of deep dive research every single week, and you absolutely do not want to miss the next setup. And if you want to go even further and directly support this channel, send a super thanks using the support button right below this video. Every contribution goes straight back into making this content better for you. I have also launched an exclusive Smart Stock Sam membership community right here on YouTube, where members get early access to trade setups, deeper breakdowns, and a tight community of like-minded investors, all committed to leveling up their investing and trading. The link is right below. Come join us and let us build something great together. Until next time, stay smart, stay patient, and I will see you in the next one.